Welcome everybody here to our next webinar at JFD Bank, and a warm welcome in the name of JFD Bank as well. My name, Stefan Friedrichowski, as always, for those kind of webinars a little bit behind trading. It's not just that I say, hey, let's have a look to a chart and decide whether we should trade euro, US dollar long or short. No, it's always a little bit more from a mathematical point of view. And today it's even a little bit more, it's more statistical point of view. So we talk about trading and statistic. Oh, I have to mention the date. Yeah, we have the 14th of November 2019, 7 p.m. So everything as always. And many thanks for all the greetings here in the chat. Thank you very much for that. Let me introduce a little bit more about the subject of today, trading and statistic. I mentioned already that we will not have a look to any chart at all. But basically, I want to introduce you to two different kind of aspects. One is that if we look to trading statistics, so if we look for a trading account with its own characteristics, or if we look to a given trading strategy, and even there it's easier to derive two key figures like hit rate and risk reward ratio, for example, that based on those two numbers, we can learn a lot about any trading approach, any trading strategy. So we can simulate trading results, and you will learn that's not everything as you might expect, and that you need hundreds and even thousands of trades until you can confirm those kind of statistics. And that leads to another question. If you, for example, if you do the development of trading strategies by your own, or you go into the internet or read some books about trading strategies, then you can ask yourself, hey, is there any real significance behind those kind of trading strategies? So is there a statistical evidence, a statistical significance? And what are the criteria to state that yes, there is a significance behind? And we will derive those criteria, and you will be astonished that most of the strategies you normally see around in the internet or in a book, that those will not fulfill those criteria. Finally, if you now have a good trading strategy, there's always one remaining question. Not only one, but at the very beginning already, you ask yourself, hey, what amount of money should I risk per trade? And there's a common answer to that. And normally, once again, you might read, oh yeah, let's go for 1% of my capital, or 2%, or 5%, or 0.5%, whatever. You will find those numbers as given. But there's something which is much more cool, and that is the so-called Kelly formula. That Kelly formula is a real name, is a quite mighty formula. It's really a simple equation, but to answer the question, what amount of money should I risk for a given trading strategy based on those two key figures, hit rate and risk reward ratio? And then you will get the answer. And it really depends what kind of trading strategy you follow, what amount of money you should really apply as risk per trade. So those are the topics of today. And if you like, you can already download the slides via your GoToWebinar control panel. And finally, I will show you 3 different Excel sheets. If you have interest in those, then please drop me a line at s.friedrichowski@jfdbank.com. I know I have a really complicated last name, so just call me Stefan. And if you do any misspelling with my name, okay. Anyhow, if you mentioned Stefan in the email, the support will make sure that I will get the email, and I will make sure that you get the Excel sheets. Okay. Oh, there has been one question. The webinar is, of course, recorded and will be published tomorrow before lunch already at the GFD YouTube channel, so you can find the recordings there as well. You know the procedure. I have always to show once during a webinar there is disclaimer, because we talk about trading, we talk about investment, we talk about trading strategies, risk management and things like that. But of course, finally, whatever you do it on your own responsibility. So that is, I think, quite self-explaining. But anyhow, it has to be mentioned at least one during any webinar. So I talk already a little bit about our subjects today. So we start with hit rate combined with a risk-reward ratio. Maybe I should just say triple R, and I hope that you then know what I mean. I mean risk-reward ratio. In the German language, we always call it CRV, Chance-Risiko-Verhältnis, but anyhow, so this would be a triple R. Okay, sounds strange, but anyhow, risk-reward ratio. And we will simulate equity curves. Honestly, we have done similar steps already in other webinars, but today we look from a different perspective, but we use that as a base. And then we go via the significance to the Kelly formula in the final end. Okay, let me start with simulated equity curves or statistical equity curves. Of course, we know that our trading strategy is can be characterized by those two numbers, hit rate and risk-reward ratio. Or can I say your complete account can be characterized by those two numbers? Yeah, finally, you can even calculate those. Hit rate is like more or less straightforward, number of positive trades divided by number of total trades, and risk-reward ratio. Okay, maybe you have different approaches, different strategies, and use different numbers for those. But what you can do is you can do something like an average. You just calculate all the average win divided by the average loss, and then you have your average risk-reward ratio. So we might take as an input a real trading account, or we just take those numbers just as descriptive numbers for any trading strategy. And if you simulate out of those two numbers our equity curves, you will really get a better feeling for your trading strategy or your trading account, because it's not always the same. If we have those two given numbers and then we simulate the equity, we will get always different equity curves, and they really look different. You will see in a second. And the other good thing is doing so, you get a better expectation attitude for what you can and might achieve with your trading strategy. Since later I will use one expression here, expectation value. That is the number we can calculate out of the two hit rate and risk reward ratio. That is a expected result or profit per trade. And of course, we should only trade something with a positive expected value as the profit per trade, of course. As you see already in my slide, I want to jump into the first Excel sheet, and I will do. And let me explain a little bit, and you might remember that we have had a different one, a similar one already, but anyhow, we can use it as a perfect base for any discussion about statistics and trading. So what we have here is just four numbers. We start with a hit rate which is now set to 50%. Then we have the profit, and let me change from the German to the English webinar, risk reward ratio, which is here set to 1. And I have a loss, which is set to -1, and I will not change that number anyhow. I only will change the risk reward ratio, which is expressed by if you divide those two numbers, but then we always take a positive number as being the risk reward ratio. And in order to have something which is more like a real trading account, I just say, okay, let's start with a constant fixed risk per trade of 10 euros, and later, as I mentioned already, when we come to the Kelly formula, then we will have a percentage value from our capital. Here we use just a constant one, just 10 euros. And we'll start with an equity of 1,000 euro. Okay, you see that I have already one equity curve here, and I decided to have 260 trades, and I did that by purpose, because that might reflect or represent a trading account where you trade one trade per day, and then we would look to your equity after 1 year. So one trade per day. Okay, let's take that one. And you see already my expectation value with those kind of numbers is, of course, 0. And yeah, even my equity looks a little bit like that. But let me start pressing F9, because that Excel sheet has random numbers. So we have, what we have is that we use fixed values for hit rate and risk reward ratios, but we can calculate new equity curves just pressing F9. And up to now they look all similar, but now I have the first one totally different. Hey, that would be already a nice one, isn't it? I mean, 200 euros earned, 20%, not that bad. But the question is, I always use the same kind of statistics, so I have not changed hit rate or risk reward ratio. Astonishingly, we get always, and we have even after 260 trades, we are in the minus. Let me first let's go to an extension before we follow my original idea what we want to do here. Let me first start with another thing you can already simulate with that kind of Excel sheet. So you can answer the question, in general, what kind of trading strategy is better? One with a high risk reward ratio like 2-to-1, 3-to-1, which are typical for trend following systems? Or what about trading strategies which have risk reward ratios smaller than 1? Which is typical for strategies like, for example, mean reversion. If you can just decide, the answer is not that obvious, because what I will do now is, let me first go here for a trading strategy with a risk reward ratio of 3-to-1. Okay, that looks nice. The equity goes north, but that is not realistic. Let me put back the hit rate to a value that we have once again an expectation value of 0. Okay, I know that is not a profitable trading strategies, but I want to illustrate something else, and you see it maybe already here by the different, if I press once again F9, hey, let's call it the volatility, the fluctuation is even higher. And to have that in a better way, I have a second page here. Same thing, same Excel sheet, but here we simulate right away 10 times the same, 10 different equity curves, always following the same statistics. And here you can see the one with risk reward ratio of 1, with a hit rate of 50%. And now let me go back here to the same I used on the other side with 3-to-1. And you might see that the overall volatility is much higher. Okay, that's not that good. And now let me go into the other direction. Let me go, for example, for a trading strategy with 0.2, and but now I need the right number for the expectation value. Let me do it here first, and that is, I think, something like 83%. Yeah, that's already good enough. 83.5, and then it would be a little bit less, but now we are close to zero. I use the same number here, 83.5, and you see, I think that's really quite obvious that the fluctuation over different equity curves is by far not that high. That means if you simply can decide, if you have two good trading strategies, one with a high risk reward ratio and a given expectation value, and you have another trading strategy with a low risk reward ratio but with the same expectation value, so your expected profit is for both the same, but from a fluctuation perspective, I would prefer the one which has less volatility, less fluctuation, and therefore risk reward ratio smaller than 1 for a given expectation value is always the first choice. Okay, that was only a side remark. But now back to our original idea that we want to have a trading account. Okay, but of course, we don't want to have a trading strategy which shows up with just an expectation value of 0. So therefore, let me go for 52, risk reward ratio 1. Okay, fine with that. And now I even say what you might not like. I have a return, an expected return after 1 year, since I say the 260 trades represent 1 year. So I have a return of 10%. And I say that is a good number. And indeed, I believe that. I know that everybody wants to double his account or her account in 1 year or even 1 month. But that's not realistic. If we could double our account in 1 year, that would mean that after 10 years, we would have 1,024 times more money than starting at the starting position. And honestly, that isn't realistic. So any number higher than in the range of 20% is definitely not realistic, at least my strong belief. Everybody can convince me that he can do better, but please do it a couple of years in a row and not just with a few trades. So therefore, I'm satisfied with 10% or 10.4% anyhow. But now the problem starts. If that is our trading strategy, and we would review our account after 1 year, then in this case, the blue line, we would be happy because our expectation value is exactly the red line here, and we are even above. But now, let's think we have another account, and that might look this way. Okay, after 1 year, we have lost money, but we have not gained any money. So it might happen. So you see that we have a high uncertainty. Sometimes we are on level, but sometimes we are below. So it's hard to decide, oh, this one would even end up in a loss after 1 year. So we would trade that strategy, and after 1 year, we would have to decide, do we go further? And I think most of us would tend to say, okay, after this year, I would stop the strategy. Let's change. Let's go for a new one. And honestly, that's not a good idea, because in this case, we know, because I put that into the calculation, we know hit rate here 22%, risk reward ratio 1. So we know that the strategy is good. But my trading result is not good. So what should I do? In this case, we know we should go further. But let's look to that from a different perspective. Let's think about we have developed a trading strategy, and we have got the result that we have 52% and something like that, those kind of key figures. how sure can we be after 260 trades that we have indeed a hit rate of 52%? Or let me rephrase that kind of question, because I'm a physician. So if I do a measurement, and we do here nothing else than a measurement, we have always to ask the question, how precise can we measure? So the question here is, how precise do we know after 260 trades that we have indeed a hit rate of 52%? Okay, in this case, the hit rate would be below, but we have always that error bar. The precision of our measurement is not zero. So, and since trading is applied to statistics, so we should know what kind of uncertainty we have after we do something like the review of that trading statistics after 260 trades. So therefore, it's a question of significance. So what is the error we can expect with those limited numbers? We know that statistics is always a matter of big numbers, so we should have millions of trades maybe. But what is the right number in order to be precise enough to say, okay, that we have at least a hit rate higher than 50%? So let's assume, or let's say we want to be at least as precise as 2%, because that would lead that we to a trading strategy that we definitely know that this one is profitable. But if our error would be here 5%, then we cannot decide with our 52 whether we really have a good one, yes or no. So that's a quite important question when it comes to trading accounts, when it comes to trading strategies, because everything can be boiled down to a hit rate and a risk reward ratio. But we have to know how precise we are in our, not really estimation, in our measurement, because the pure calculation of the hit rate is perfect. We can do that with 10 digits after the comma, but we have to know the statistical uncertainty. Okay, let me go deeper into that topic. But first, once again, what is the message, the take-home message already from the first investigation? So we know already that smaller risk-reward ratios have a smaller fluctuation band, which is good. So if you have the lucky situation that you have maybe different trading strategies with the same expectation value, then I would always go for the one with a smaller risk reward ratio, because then I have more smooth equity curves with less drawdowns. So definitely I would prefer those. So that is already learned just from simulated equity curves. That's nice. But now back to the question, how many trades are sufficient in order to have a significant statistics? That's a quite fundamental questions. There are honestly statistical tools and methodologies to answer those one, but reading and introducing those, they are quite complex. Therefore, we do everything here just with a few Excel sheets, because then we can visualize our results, and I think we can more or less to the same kind of answers. The other question behind is from a developing point of view, that we need to know how much history we should have. So I develop trading strategies, let's say on the D1 base, and I have for the last 20 years I have 100 trades. So what is my statistical uncertainty, or the other way around, significance, having a good trading strategy out of those 100 trades in the last 10 or 20 years? And we need a defined criteria for that, and that we can do. Okay, Let me go for the next Excel sheet, which is especially meant for that answer. What I've done here is something quite similar to the first Excel sheet. Let me guide you through what you see here. Once again, we have a profit, we have a loss, but now no euros, just those two numbers. And finally, just a remark, this Excel sheet, straightforward, is definitely meant for something with a risk reward of 1 and a threshold of 50%. That has to do with one calculation later you will see in a second. Now I have extended the number of trades up to 10,000. So we have 10,000 trades here. And what you see in the lower right corner is once again that kind of equity as the previous Excel sheet. Since we have an expectation value of 0, yeah, that might be our equity, of course. And if I press F9 again, we would have a different one. But that is the typical representation of such trading statistics. But what about that picture with the red and the yellow line? Let me go directly into my Excel sheet, then you will for sure understand what I've done here. The question I have asked myself, so starting after the first trade, which in this case has been a winner trade because of the +1 here. What I can do after one trade, I can calculate the average of all last trades, in this case just one. Okay, therefore we start at 100% because up to that moment we have exactly one trade, and that was a winner one. Look for what I have in the second line. Now I can calculate the average of my trades after two trades. Okay, since the second one was once again a winner trade, I have once again 100%. And with each additional trade, I can look back to my trading statistics and see now, okay, I've done 3 trades, 2 winners, 1 loser. So my average is 33%. And if I press, for example, not the picture, just that cell here, then you can see, okay, I can now create the average of the last about 15 trades. So, and that is exactly what I have plotted here with the blue line. Of course, with threshold 50% risk reward ratio of 1, that blue line should converge. How is it called? Converge? Oh, konvergieren in German. So should go more close and close to the 0 line. So that's for sure, because the more trades I have, and since I start, or I put in that we have a risk reward ratio of 1 and this a hit rate of 50%, of course the blue line should come more and more close to the 0 line. We know that. And of course it's confirmed here. But now you can see what I mean with my red and my yellow line. Because they create a corridor here. And that corridor, and I will, in a second, I will show you what kind of formula is behind those two lines. If I just press F9, then you can see, even if I have a new statistic, more or less in all cases, they really, those two lines, the red and the blue one, the red and the yellow one, they create that kind of corridor. So with more trades, I'm getting more and more precise in my measurement. Hey, that was my question. I want to get a number for how precise can I measure a hit rate after a given number of trades. It looks already that my two lines, the red and the yellow one, are really something like that precision. Because, and I even create a number, how many of those numbers are within that range, and this is given here in that cell. In this case, I'm at the end, I'm sometimes out, but anyhow, you see, I really follow that kind of corridor. That's good. And the corridor is really easy represented. If you see what is behind that Excel, that cell, it's just 2 divided by number of trades square root. Hey, that's all. And that's the basic, let's call it formula of any statistics, the 1 over n square root, because that is something like the statistical uncertainty, and that is exactly what we need here in order to answer the question, how precise can we be after a given number of trades? And you see, oh God, we need a lot of trades in order to come to, what did I mention? I want to be precise as 2%. The good thing is I have already done the calculation because for my trading strategy with the 52%, I decided, hey, Craig, I want to have an error of maximum 2%. And since I have done the calculation, so just solving the equation for the number, for the given precision, which is then 2 divided by precision square, you see, I want to have 2% as a given precision, and you see how many trades I need. 5,000 trades. So only if I would execute 5,000 trades, I'm within my error of 2%. So only then I really could state I'm above the 50% threshold. Whoops, that might be a little bit disappointing for anybody here. Back to the what I said, 260 trades, let's round it up to 250. That would mean after 20 years. So only after 20 years I'm precise enough to say I'm above 50%. What a nightmare. But it is as it is. So statistical significance, and we may take out the 1 here, the 2, the factor of 2. I put that into the equation here just to have more or less in most cases all my numbers within the corridor. So we might discuss the 2 here and replace it by 1. Okay, then we would have not 5,000 trades, but 2,500 trades would be 10 years. It's a long time after we can really decide what we aim for. And back to the question, if you develop a trading strategy, you really need a lot of history. You really need a lot of trades in order to statistically decide whether you have a profitable strategy, yes or no. Even if it looks like being profitable, it might be just a statistical representation of what you have done. So remember, not always, in this case it's down here, but it's not enough to have an equity curve which goes north. That's not already enough. We need statistical significance. But the good thing now is we know when we reach the statistical significance. And that kind of formula gives you the answer. So what does it mean in reality? So deciding after 260 trades, I have a profitable trading account? The answer is, of course, we can decide. If the number is above your starting level, then you have a profitable account. But is it a statistical, significant, profitable trading account? You need exactly to measure your precision. And that can be done with those easy formulas. So that gives you hopefully a new insight into any trading strategy. And be aware that most, oh, sorry, now I'm on the wrong page here, that most trading strategies you might read in books or get to know in other webinars, they would not fulfill those kind of criteria. So let me summarize those once again. So if you want to measure a hit rate with a given precision, plus minus X%, then you need 2 over X square trades. So in my example, if you want to have an error bar of 2%, I need 5,000 trades. Whoops. And most of those strategies which are wherever described, they will not fulfill that criteria. But now I have a remark to make here. This does not automatically mean that they might nevertheless work. So even if they have not the statistical significance, they still could do its job. So I cannot say it's definitely a no-go. No, they might work nevertheless. And even vice versa, I have unfortunately the same. So even if you have a trading strategy which fulfills those criteria, that gives you not a guarantee that they will work in future as well. As always, because if we have something derived, the future is unknown. But for me personally, it's a quite important precondition to have trading strategies with a statistic which really fulfill those kind of criteria. And those, and still I don't have a guarantee for any future behavior. Yes, unfortunately, the answer is I don't have it. But now we are at the point, let's say we have a good trading strategy, and I still will work with my 52% hit rate and risk reward ratio of 1. But now we have a luxury question, so to say. We have a good trading strategy, and we can ask ourselves what amount of money I should risk per trade. It's a simple question. And typically you find answers in the literature like 1%, 2%, half percent, or whatever. But that number is not correct. You can use those, yes, but you can do better with a different approach. So the question is how much in percent, now I change not to a fixed risk per trade as up to now, to a percent number of my capital, how much risk I should apply as being the risk per trade in order to maximize my profit. You might tend to, the more percent I would risk, the more result I get. And the answer is no. Then you will lose all your money. And I can show you that you will lose all your money. Because if you invest or risk too much in percent of your capital per trade, then you will definitely get bankrupt. Definitely. That might be astonishing, but you will see in a second. Since I will not come back to that slide, I already give you the answer in the formula, which is given by the Kelly formula, who has derived that kind of number. And you see how it's done. And once again, you just need the hit rate and the risk reward ratio in order to calculate that number. Let me illustrate what we are really doing here. So now we don't have any more a fixed euro amount per trade. No, now we have a percent amount per trade. And you see, my Excel sheet once again looks quite similar to the previous one, but there are some changes. Let me show you what I've done here. So we have a hit rate, okay, we have a profit, which more or less means here's a risk reward ratio. We have a loss, and now that's new. We have a risk per trade, which I start here with 1%, and I have a starting capital of 1,000 euros. Okay, we know that this works, and the strategy has an expectation value if we would have of 0.04 here. Okay, but now we are doing something different from previous. And you see, just if you follow here the lines, that for our first trade, we risk 1% from our capital, which means 10 euros. And in this case, unfortunately, we lost with our random numbers here. So after the first trade, we have just only 990 euros. That would mean that for the next trade, we will risk 9.90 euro. And in this case, we lose once again, and so on. And here's the first winner trade. And you may already realize what's the basic problem and why you should, and I will show you in a second, what might happen if you go with 10% per trade. Let me already do the quick calculation before we really go further here. Let's say the first one is a winner trade, and we have our risk was 10%. So, okay, so if the first was a winner trade, our risk would be 100 euro, and our profit, being a winner, would be 100 euro. So after the first trade, we would have 1,100 euro. So the next trade, we will risk once again 10%, which is 110 euros. But now if that is a loser trade, we are below our starting capital of 1,000, because then we would have 990 euro. And here you see the dilemma. That's the reason why we for a given hit rate, we can use too much money. Okay, what I've done here else, because even here I can do the calculation of so-called expectation value or an expectation factor, but because now I have to think in factors because we have a percentage value of our risk per trade. And you see how the logic works. Now I go for 5,000 trades here, and with a given hit rate, I have 2,600 winners and 2,400 losers. All my winners would be a factor or a winning factor of 1.01. If my trade risk is 1%, and all my losers would be a factor of 0.99. And now we can, so to say, sum up everything, which means we have to multiply those things. Therefore, the sum is in brackets here. All the winners, the 2,600 winners, would give such a factor, and the 2,400 losers would give that factor. Those multiplied gives our expectation value, and that means we can expect, after 5,000 trades, starting with 1,000 euros, we can expect close to 6,000 euros as our final result. Okay, and now you see my graph. And I have plotted the expectation value. I have plotted now the y-axis logarithmic scale, because of course we need that. And we have the expectation line here. Now, first, it's the same like before. It's statistics. So we might be above expectation value. We might be below. Just pressing F9 gives always a new calculation. Good. That we know, because that's pure statistics. But now let's go higher with the risk per trade. So please remember that yellow number here, 5,700 euros, because the graph itself will not tell you everything being statistically impact. So let me change to 2%. Okay, I went up from 6,000 to 20,000 expectation value. Wow, good. Let's go higher, 4%. Wow, now we are at 54,000 euros. Perfect. And now even higher, 8%. You see what happened? My expectation value is now 900 euros. So after 5,000 trades and a risk per trade of 8%, with a profitable trading strategy, to emphasize that, we are at the same point like before 5,000 trades. Oops, what happens if we even go higher? 12%. Okay, you see 0.01 euro. So obviously that was too high. I introduced already the Kelly formula, and that's already implemented here. So we know if we risk too much, we even lose money with a profitable trading strategy. And we saw already that if we are with very small numbers, we may not realize as much profits as possible with the same trading strategy. But we know already the answer. What is the optimal value for the investment ratio? And that is 4%. It's just applying the formula of my slide with the numbers of hit rate and risk reward ratio. So we know for 4% we have the highest expectation value, and in this case the highest expectation value is close to 55,000 euros. If we go below, less risk per trade, like 3%, we have a lower number. If we go higher, like 5%, we have lower numbers as expectation values. And we have the best one exactly with the Kelly criteria, and that is, in this case, with a hit rate of 52 and risk reward ratio of 1. It's just 4%. Hey, that's good to know. But there's a but. Remember what we discussed during the first half hour of my webinar. There's a high uncertainty for a hit rate for a given account. Okay, then we know it, we can do the calculation, but there's a statistical uncertainty. Even if you have a number of 52%, should it be wise to think it's really 52? Maybe we should reduce it a little bit. But let me first start illustrating it once again, just as the trade risk. So what I've done here is I have my hit rate, I have my risk reward ratio, and now I'm back at 260 trades, just for illustration purpose. And now you see I have my y-axis, my x-axis here being the trade risk. And then you see exactly what we have realized already on the previous Excel sheet, that if we start with risk per trade of 0%, okay, that means we do not trade, and therefore we will not lose and we will not gain anything. But anyhow, so therefore the profit after 260 trades is still 1, so that's a factor. But if we increase the risk per trade, we get more and more money. But if we go above the threshold or the Kelly formula, in this case 4%, then we go down once again. So if we do not know the hit rate number that precise, and we know that we do not know any hit rate precision enough, then we should always go to the left side. So we might calculate that 4% is good, but let's always go to the left side, because then we have we are on the safe side. If maybe our real hit rate is a little bit less, let me just go for 51.5, then you see the Kelly goes already from 4 to 3. So it's better that we are on the left side from the Kelly criteria in order to be always on the safe or more safe side. And there's a rule of thumb, just go for Kelly half. That's what you can find in the literature, and that has another implementation or advantage. Let me go here for Kelly half, meaning not for the 4%, being the investment ratio per trade. No, let me go for 2%. There's another good thing. Okay, let's start with a not good thing. Originally, we have had an expectation value of above 50,000. We lost a little bit more than half of our potential profits. Yes, but we gain one thing else. Just let me press a couple of times F9. Then you can see that the overall fluctuation is by far not that huge as being before if I went exactly for the Kelly criterion. So therefore, we have a little bit less fluctuations. So that's another plus for always going for half of the Kelly formula. But nevertheless, it's a really mighty formula that Kelly criteria, because we can answer now the question, what is the optimal number for the risk per trade if you have a given trading strategy, maybe developed by your own, maybe found in the internet, maybe just looking to your 10 years track record of your own trading results, whatever. So we know now that we have a formula which gives us the Kelly criteria, and then we have that kind of number. In my case, it has been 4%. But now, and I have more or less already illustrated, that's the first statement here on that slide, that if we go above 2 times the Kelly formula, remember that was the 8% and then further, then you will definitely lose all your money. You remember? I will repeat it just that you realize it once again. So at 8, that is 2 times Kelly, we are back to we don't earn anything. And if you go above Kelly, we are on the loser side. In this case, statistically, we won, but our expectation value is more or less 0. So as you can see, €6 here. Sometimes we even will win with those kind of numbers, but that is the expectation values. So there's a guarantee for loss if we are above 2 times Kelly, and if the right decision, since we know that it is quite difficult to have the, let's call it the correct hit rate, therefore it's always recommended to apply only half of the Kelly formula to be on the left side of the maximum. That's a quite mighty tool because it answers the question how much money you might invest for a given trading strategy. And that brings me already to my summary for today. And let me first start once again with simulated equity curves. Please do it by your own, and you can have those kind of Excel sheets or you create them by your own, because that gives you really a feeling. And you might remember that just pressing F9 sometimes gives you a profitable trading account, sometimes a non-profitable trading account. And that's pure statistics and nothing else. And you know how difficult trading is. And only trading statistics can lead to losing accounts, and you just would have to wait. So play around with those statistics, then you get a feeling for what you have. And we talk about statistical significance, which is really important because even after 260 trades with my winning trading strategy of 52%, we could not be sure that we have really a good trading strategy. We learned that we would need 5,000 trades, and if we take out two in my equation, then still 2,500 trades. So you would need 10 years if it would be a one trade per day trading statistics in order to decide whether we are really on the profitable side. So we need high numbers of trades in order to decide something like that. And I think it's more trades than you might have thought about. Finally, if we have a good trading strategy, then the introduced Kelly formula provides you a reasonable value for your risk per trade. And in order to be on the safe side, just go for Kelly half. You know the reasons, uncertainties, and you get a little bit less fluctuations, which is quite good as well. So, and we started with the first statement: smaller risk reward ratios at the same expectation values are even better than higher risk reward ratios. Once again, the reason is fluctuations and drawdowns. I hope that has been a quite interesting webinar for you as well, even if we have not looked to any chart, just to have some background information about statistics and statistics of trading, so that you learned a little bit and can go further and better with your own trading activities. That's for today. I wish you all the best and enjoy your evening, and see you again in 2 weeks maybe. Then we discuss really a direct trading strategy. Let's see. Have a good time. Bye bye.